Why should you care about capital preservation, and when would you ever even run into something called capital preservation? In this video, I'm going to talk about the importance of capital preservation because if you're an investor, it's something you're going to see over and over again. Hi, I'm Camille Gaines. Here and on my website, retirecertain.com, I talk about what I've learned on my investing journey since I was in my early 20s, which was a long time ago, and creating alternative income streams over the past 15 plus years with my husband. You won't hear about passive index stock investing here, maybe occasionally a little explanation around that, but usually I talk about alternative strategies to build wealth as well as income streams that are a little bit alternative. Capital preservation is something you run into in the financial services industry, and you'll see it if you're, for example, looking at a mutual fund or any kind of fund really that you're evaluating with some kind of service, or if you're meeting with a financial advisor or a wealth manager. One of the big topics or one of the big things is investing objectives, and one of the objectives you'll see is capital preservation. So what does that mean? I find that the terms that are used in the industry are just kind of really complex, but if you think about it, it really makes sense. Because your capital is your money, and your preserving your money is simply, well, preserving your money. So what does that really mean? It means not losing your money. But if you met with a financial advisor and they showed that the main objective was to not lose your money in a particular fund, then you'd probably think, well, isn't that your objective for all of my investments that you're managing for me? Or if you're looking at a mutual fund or some sort of fund, not necessarily a mutual fund, and you see capital preservation as a main objective, you might think that that's just a given, but it really isn't necessarily a given, and I don't think you want it to be a given. Now, I'll get to that in just a second, but I do think that the term is often used because it just sounds so much better than losing your money. And saying to lose your money as a major objective sort of triggers feelings of fear, and I think would not go well in a meeting with a financial advisor or wealth manager, or even in doing your own research for evaluating an investment that you're making. So capital preservation is really important, but you don't always want that to be the main focus of your investments. You don't want not losing your money to be the primary focus, and I'm going to share why. What we're really talking about here is risk. We're talking about taking risk in a way that allows you to invest your money with the highest return that you can get for it, but within your acceptable level of risk, right? You may have seen my other videos where I talk about you get to choose the amount of risk that you want. It can feel like when we invest, we don't get to choose, that we're just subject to whatever's happening in the environment, or in particular, the stock market. But we do get to choose the level of risk that we want. Simply by looking at how our investments have done historically, we can get a really good feel for about how much risk we have. Okay, so having said that, we don't want to not have any risk, because the problem we run into when we don't have any risk is we don't build wealth. Not only that, we lose money when we don't invest. When our money is tucked away safely in a money market or other type of investment that doesn't fluctuate in value, we're losing money unless that money is adjusted for inflation, or we're able to capitalize on opportunities that present themselves while we're holding that investment, because our money is tied up. So opportunity cost happens when our money is tied up and we can't take advantage of opportunities that surface. If you're an investor, you've probably seen, or at least I know I've experienced this, where I saw an investment that I absolutely knew we should purchase, but our money was tied up. And so having that money tied up, then you're unable to invest the money. And that is opportunity cost. That is losing out on an opportunity that's presented itself. Now, circling back to capital preservation, if we have capital preservation as our main objective, then there's a chance that we'll have that money not doing anything. Now, a lot of funds and financial advisors and wealth managers say that the main objective is capital preservation, yet that money fluctuates in value. As individual investors, though, if we say, this is my emergency fund, it's my contingency fund, it's my fund that I need, my money I need to have if I lose my job, or if the stock market crashes, or if something bad happens and I'm not making either investment income or I'm not getting the money that I thought I was going to be getting every month to pay the bills. And that is where we would have 6 months to maybe 2 years, depending on, or longer, depending on your situation and what you're comfortable with. But it's also super important to know that while that money is going to have capital preservation, which just means not losing it, first and foremost, where there's no risk of losing that money, then that's when capital preservation becomes so important. But we have to balance that with not too much money in there, because if we do that, we can't build and compound our wealth. We can't take opportunities, and we also lose the value of our money to inflation, because inflation erodes the value of our money every single year. So that's what capital preservation is. You'll see it in the information when you do investment research or if you meet with an advisor. If you like this information, be sure to subscribe to my channel and watch this video next.